winning 90% of your new business because you have some sort of incredible value.
I'm going to take a bit of a different angle.
I've got a budget this big. I'm going to give it to you because you have a really killer plan.
You give a Red Bull to a turtle, what do you expect?
I think that's a dead turtle. So let's move on to...
E-break.
Cheers.
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 Does your current premium finance company lock you into long-term agreements? That's because they don't want you talking to us. At IFS, we win your business the good old-fashioned way, with customer service. I know you don't always have to use a premium finance company, but when you do, you should use IFS. Cheers.
Hi there, and welcome to the Digital Insurance Pint podcast. As always, I'm your host, Tom Reed, joined by my colleagues, Steve Earle, CEO of Bald Insurance.
Hello.
Adam Mitchell, CEO of Mitch Insurance.
Hello.
And Jeff Roy, CEO of Excalibur Insurance.
Welcome, listeners.
And we are again pleased to be joined by Alister Campbell. Clearly, Alister did not get scared off by our first conversation and is back and ready for more.
Glutton for punishment.
That's right. We already know a little bit about Alister. We're going to dive a little deeper here. So I'm going to get Jeff to give him a couple more rapid fire questions just to really find out what makes Alister tick.
Thanks very much. And Alistair did such a good job in the first rapid fire. We had to do a couple more to keep this the podcast going here. Alistair, if you weren't the safety net guy for the Canadian insurance industry, what would your plan B career have been? Now, I know you did a lot of things in your career, but is there anything else that you didn't do or plan B that you're like, I wish I'd have done that?
I don't have a lot of regrets, honestly, but I did get to be CEO of a couple of companies, 5 years each, roughly. If I hadn't kind of seized on the PACCIC opportunity, I would have probably gone out to see if there was somebody who was ready to see if they were third time lucky. I think I probably would have looked for an opportunity to lead another business in the same sector because, maybe I'd have learned something.
So you're a firm believer there's no better industry in the world than insurance done right.
I think that is exactly right.
In one sentence, what is the best thing about being in the Canadian P&C business in 2026?
Most interesting market ever.
Why do you say that?
I think we're going to get into that.
There is so much going on. And so you've got international trends. You have incredible shifts in the global capital pools for insurance and reinsurance. You have structural change in the market shares of the major players in the Canadian P&C space in parallel with giant shifts in the broker channel and an accelerated growth in an MGA distribution world that's happening in parallel to all of that. And there are so many, like we sell home, car, business insurance. Most of it hasn't changed in a long time. But the number of new risks, including cyber, to have a whole new peril is super rare. You could go 50 or 100 years without a new peril. And we've got at least a handful of them that are emerging just in the last 15 years. There is a lot going on. And I don't think there's ever been a more interesting time to be engaged in this market.
Well said. Well said.
Okay, so let's get into the meat of the episode here. But first, I'm going to give a big shout out to IFS Premium Finance, our key sponsor. Thanks very much, guys. Appreciate all you do to support us. So we're going to talk hard and soft markets, riding these different cycles, why they happen and how to manage them.
I guess the opener is, are we in a classic cycle repeating that you've probably seen a dozen times over 35 years? Or is there some sort of new normal to this from your perspective?
So we are a market, not just an industry. And so the price of insurance capital moves, and the appetite for insurance risk kind of moves with it. So, my first experience is a newbie back in the mid 80s. There was a spasm hard market attached to liability risk in Canada because you had a kid on a roof in a school in Brampton, and suddenly they got a generous court award that nobody'd seen in Canada before, and it caused a spasm. So you can see that kind of event-driven hard market that is directly connected with a recalibration of everybody's estimate of risk at the same time. You think of the hard market after 9/11 as probably one that's more familiar to the age category of this podcast. So you would have seen it or you would have heard about it. It was 18 months. It was an event, but it wasn't a permanent or lasting one. And we've had now in Canada a quite sustained hard market for quite a long time. And that has now changed. You can tell me when you think that started. I think it started about 2.25 years ago in the specialty D&O space, and then just kept rippling its way through. But now I suspect you're discovering what's the Letterkenny super soft. This is super soft. So what's causing that?
You're 10-ply, bud.
Exactly, 10-ply.
The reality is that this is the 6th consecutive excellent year for the Canadian P&C sector. The ROEs for 6 consecutive years are above the average. So normally, when that happens, the margins get competed away quite vigorously because we're a market and nobody has enough market share to stop that competition. We're not an oligopoly like the Canadian banks. We're not an oligopoly like the Canadian groceries or the telecom. We're a market. And so if there's profit to be made, people will chase that margin and erode it. So historically, when you see numbers like this, you see a soft market and you see ROEs fall. You would assume that ROEs will start to deteriorate, but it is a very segmented soft market. People are still pretty cautious about property insurance in Canada. And people are still scared witless of car insurance in Canada. The profits have been in commercial, and most notably in commercial liability. And so I think you have to assume that everybody is reallocating capital to try and capture more commercial margin. And so the margins will have to erode. How quickly that happens, hard to predict. But there's portions of the industry that are still properly priced or actually need more rate. But commercial lines has been pretty good for everybody. And so you have new entrants to Canada that are trying to write it. You have major players that are trying to maintain or grow share. So I would expect the commercial line soft market to be a sustained challenge for the next couple of years at least.
That was going to be one of my big questions, the crystal ball. Now, the last time I saw you, so this is April of 2026. I saw you in January, I think. And your answer was the same then. So there's really been nothing happen recently with what's going on in the Middle East that might lead you to believe that there could be a shortening?
No, I don't think so. And since we saw each other back at the start of the year, I've been doing some more thinking and discussing with folks about that new development I mentioned. So maybe just catch everybody else up. A giant input to the cost of goods sold for our industry is the cost of reinsurance. And in kind of 22 to 24, Canada experienced quite a substantial hardening for reinsurance pricing. Insurance companies had to see their own net retentions, their own deductibles climb a lot. And almost all aggregate loss property treaties kind of disappeared from the Canadian market. They just weren't available. And then we had a terrible cat year in 24, record 9.4 billion. So you're not expecting much to change. And in the last 6 weeks of the 2025 reinsurance renewal season, the Canadian reinsurance market suddenly turned out to be super soft.
Mm-hmm.
And so I've been doing more detective work on what happened there, and I think I have a better handle on the specific drivers of it. But the fact is that the global capital pool available to reinsurance companies is substantial. There's whole new waves of capital arriving in the form of insurance-linked securities from investors who are looking for risk uncorrelated with financial markets and finding it in catastrophe bonds. And so the combination has led to suddenly the cost of goods sold for Canadian primary underwriters fell. And it fell after they'd submitted their plans to their boards. So you got hundreds of millions of windfall new capital that arrived after plans were submitted. And that now needs to find premium to be backed. And so another contributing factor to further softening in commercial lines you'd have to expect.
Did that board submission timing, doesn't that make it a short-term cycle of like inside this particular calendar year, they're flush with petty cash to make some wagers?
Yeah, so it wasn't quite as soft worldwide, but I just read a report this morning of the April renewals, and it seems to have happened everywhere else on the planet now. So I wouldn't count on getting a break anytime soon. But yes, reinsurers sell an annually renewable treaty as well. So if things suddenly go bad, the prices will rapidly adjust.
And speaking of going bad, so in our last episode you were on, you had mentioned there was some common behavior behind insurers that fail. And there was 1,000 of them since 2010 or something like that worldwide. And in your role as PACCIC, do you see these behaviors more often in soft markets where insurers could? So if you look back at the 2 or 3 that happened in Canada, or if you look at other jurisdictions, this behavior that tends to lead to organizations like yours, who are the last, of course, line of defense for a policyholder, are these behaviors occurring more in hard markets or soft markets?
I think the answer would have to be soft. Normally the folks who go bust do so by vigorously cutting rate even more than everybody else in order to gain market share or even do cash flow underwriting. I'd say soft markets are definitely more troubling. Now, you can have a hard market for a really good reason, like the losses are way worse than everybody thought, and you could have somebody who turns out to have more of whatever that is and get in trouble. But no, I would say the largest risk for us is soft market. But I would say that if you look at the PACCIC history compared to where we are now, I mean, when PACCIC was formed in 1989, there were almost 500 insurance companies in Canada. Now there's 161 members of PACCIC. So we've had huge consolidation in the market. There are far fewer poorly managed companies left. I'm not saying there's zero, but the number of companies that are prone to making the mistakes that historically caused failure, Canada has way fewer of them than we used to. And the sophistication of the regulators is greater. The sophistication of management is greater. The capital standards are higher. The actuarial standards are way stricter. There's all kinds of reasons to be optimistic that when you are looking at our 5 options on what to recommend to a client, all 5 of them are good companies. And that didn't probably used to be the case 2 generations ago.
That's good to know. I wanted to kind of jump into, Alistair, the kryptonite of the market share. You've said before that in business, you can actually have too much market share. How do you explain to a growth-hungry CEO or a frustrated broker that less is sometimes more when the cycle turns? Yeah,
so I would say that my perspective on that is a narrow one around aggregation risk. So when the wind blows or the floods run or the ground shakes, it does it in a prescribed geographical area. And so you always have to be conscious of how much exposure you have in a narrow defined geographic area. And so that's the context in which, you can have too much market share. If you have 90% market share of a profitable line of business, good for you. And I'm not saying that's fatal, but you can end up accidentally having more share than you deserve of a place that gets particularly hard hit by an F5 tornado or a substantial ground shake. And suddenly you'll discover that what you were buying your reinsurance and measuring your capital against was a market share of X and an exposure of Y. But where the thing happened in a place where you had way more exposure than you understood. And then your losses could be far more than you anticipated and maybe more than you've got.
Makes sense.
1985, Hurricane Andrew severely hit Allstate, like a giant company. How is that possible? Well, their most successful agent, 9 of the last 10 years, getting the award every year, was the Allstate agent in Homestead. And Homestead was obliterated from the map by Andrew, and they had 90% market share in the town. They did not understand that they had that exposure. It went through the top of their reinsurance and went against capital. They're a giant company. They survived. But since then, everybody has started trying to be more rigorous about aggregation risk in more narrow areas. But that's a granular level of detail. And when you're trying to make a plan as the regional vice president of X or Y, it's pretty tempting to ignore those constraints if a broker's bringing you a great opportunity and it happens to be in the same neighborhood as everything else you've already underwritten. Maybe you just take it anyway. Those are the risks that can lead to problems.
We haven't talked about it in a while, but it's an interesting rubber hits the road on what we used to talk about, the distribution of risk inside a digital model that's fishing online versus a neighborhood parade you repeat annually and saturate a neighborhood. And what's probably replaced that a little bit in the last 5-10 years is the aggregators buying up, all across the country, now equally have spreads of risk.
There's a lot. I used to spend a lot of time on the digital side of things. My experience in that is way less current than yours now. But I did spend some years doing the marketing for Bel Air when I was at ING, now Intact. And one of the realities you had to do to deal with is that the people who were shopping were people who, by definition, had a reason to shop. Normally that their price was higher than they wanted. And some of those people, their price was high for all the right reasons. And so you had a risk that you were accumulating adverse selection through your digital marketing strategy if you only took the inbound. You had to work out how to get your own targeted clients to come in. Otherwise, you were just getting the riskier end of the spectrum with underwriting risk that directly attached to that. And so every time you think about digital tools that make it easier to do business, you have to work out who's going to find those most attractive first. And they will be riskier profiles. So
in that line of thinking, we obviously talked tons about technology on this podcast. That's why we started in the first place, honestly. We've been talking a lot about AI, generative AI, and other forms of AI that are rapidly being introduced into the marketplace with varying degrees of success. Do you see that some of this rapid implementation of AI tools might have an inadvertent impact on some of this risk selection or other areas of stress within the industry?
Well, I think the places where AI is going to be most useful most immediately is going to be on the claims side of the equation, fraud detection, and all of the areas around that. Just red flag raising. That's 2/3 of a 100% of a combined ratio is on the claims side, and so I think the AI tools will find great homes there. They will falsely identify problems. But all the tools we've used with humans have done that as well. And so I don't see the risks from AI as urgently there.
I've seen tools on the claim side for sure. I've seen, and it's probably where I'm looking is why I'm seeing them, but I see a ton of tools on the sales side, right? Whether that's support for underwriters or whether that's, I'm actually aware of at least one, AI agentic based tool that can do the entire soup to nuts, write the policy, talk to the customer, underwrite the policy. If you really want to stitch all the pieces together, you could do the whole thing without any humans in the loop.
Yeah, I think there will be huge productivity gains to come from these tools.
Yeah.
There's also a risk of disintermediation of experts, or even more broadly speaking, disintermediation of all humanity. All of those science fiction things we read as kids are happening in our lifetime now. But my experience is that there is a human instinct and also an underwriter's expertise that comes from knowing which drop-down menu of questions to next ask. And I don't know that those agents will be as good as that right away. So my last role at the guarantee company, I wanted to be in all the lines of business where an expert human underwriter was still a competitive advantage. That was, we weren't going to try and compete against the big machine learning technologies that Charles Brindamore has built at Intact. We didn't think we could do that. But where an expert human could still make a difference, I thought that would be a great medium-term strategy for a company. And I think if I was a broker today, I would be thinking the same way. Where can I bring value where that human interaction will still be meaningful? And I believe there are enough of those left, at least for the next few years, to prosper.
But I think it's semi off topic here, but I think there's huge opportunities, especially on the broker side, to take away a bunch of the non-value added grunt work and allow brokers to actually do a better job of getting under the risk, getting a strong relationship with the client, really understanding what they're doing, because now I don't have to spend 7.2 hours a day filling out forms and other crap that nobody's going to look at.
Yeah, I mean, we've watched the business model for, what target EBITDA for a Canadian independent insurance broker in my lifetime has gone from 20, and you're now seeing folks who can run at 38, just because the number of files per CSR has quadrupled. And that's before you get to AI. So I think the margins have got better because brokers have become far more productive than they used to be. It was, as we discussed on another podcast earlier, a lot of paper in the olden days, a lot less of it now. So yes, AI is another set of tools that can be used to good effect. They have probably medium-term, more systemic impacts than tools we've seen before. But I think my life was transformed by learning how to use a laptop before my peers. I went back to business school, did a huge tech upgrade by force, and could suddenly produce my own correspondence, make my own presentations, do my own spreadsheeting. All of those were things that folks used to delegate to departments and take weeks or months to produce when I was doing it because I'd got new tools. So I think that's the way, if I was a young person entering this business now, I would be working out how to make those tools sing more than anybody else that I was in my peer group. And there's got to be ways to succeed from that.
Yeah. When I talk about AI to people, I usually use the relatively rough analogy of a carpenter, right? So you've got the carpenter back in the 1800s who's got a manual plane and a manual saw and what have you, and they're a craftsman. And I actually have a piece of oak cabinetry that's 40 plus years old that I've taken apart and put back together again multiple times to move it because it weighs about 8,000 pounds. But it is so well made that I can do that. If I try to take apart some of the Wayfair crap, it'll just break. But you give that craftsman a radial saw and a electric sander or whatever, and then now they'll make 4 of those amazing cabinets in the same time it took them to do one before. So it's still down to the craftsman, but the tools can make Craftsman A, 4 or 5 times more efficient than Craftsman B.
You probably have some more boring insurance topics that you want to ask about, but back here is the Samuel Pepys Diaries that I'm now volume 5 through. And he's super excited because he's just traded in his old watch for a new watch. And he's been carrying this thing around proudly and checking it constantly. But the new one has minutes as well as hours. So he was walking around saying, oh, it's almost 3 o'clock now. The thing only had one hand on it. And so upgrading to a 2-hand watch was a giant leap in 1665. So yes, we're all just continuing as humans to get better tools. What are we going to do with them?
Okay. So I guess in closing, the veteran's wisdom, the veteran's advice, if you were sitting down with a young commercial broker who's only ever known the hard market, what's the one piece of cycle wisdom in the market, as you say, you'd like to give them to ensure they're still in business 20 years from now?
Can't fight the market. I think would probably be the first half of the sentence. And the second half is that in that context, you need to do everything you can to show your key underwriting partners that you care about their result too. You can't fight the market. You're going to have to go and do what's right for your customer. But if you need to survive for 20 years, you're going to need markets when the soft market ends. And so you have to accept the reality of the price today is what it is, and compete in that space to gain new business, protect the clients you've got. But you've got to have underwriting partners that don't just feel that you're 100% transactional. And so that's good relations with clients and key relations with underwriters.
Move their business with a smile, is what you're saying.
Yeah, it's. I don't think I want to keep this with you because it's going to be priced too low now.
That's a great way to put it. I love that one.
Yeah, you can use that. You can use that. I never liked it when somebody used it on me.
Alistair, is there anything you want to add to this conversation?
Well, again, maybe the other advice for a young commercial broker. Sales between human and human will continue to be the primary way buying decisions are made in commercial lines for at least our lifetimes. And if that's true, then the discipline of making sure you know what your client's business is before you go into pitch, and the discipline of keeping up with what's going on in their business enough to be a value-added risk advisor for them will be the difference between your relationship and the next quote they get from somebody else. So customer focus is the way to survive in any industry over a sustained period of time. But in our line of business, for commercial especially, customer focus wins.
Is retention important to your brokerage? Of course it is. That's why at IFS, we have a cancellation prevention process. Want more details? Give us a call. I know you don't always use a premium finance company, but when you do, you should use IFS. Cheers.